Okay, good morning everybody and thank you for joining me. I'm Donnie DeLange and I'm going to take you through Alphabet's fourth quarter results. Just a quick overview of what I'm going to talk about. We're going to take a look at the nature of business. Then we'll jump straight to the recommendation. We'll highlight some key points of their fourth quarter results. We'll take a look into their main divisions and we'll look at the company's guidance for 2018. And as usual, we'll finish off with a portfolio guidance. Okay. So first of all, Alphabet Inc. is an American multinational conglomerate. Alphabet operates as a holding company, and the company, through its subsidiaries, provides web-based search, advertisements, maps, software applications, mobile operating systems, and much, much more. It was created through the corporate restructuring of Google in October 2015 and then became the parent company of Google, and as well as the several former Google subsidiaries. The two founders of Google assumed executive roles in the new company, with Larry Page serving as the CEO and Sergey Brin as the president. All right. Now, just the next slide, just showing you the Alphabet's portfolio. It consists out of several industries, including technology, life sciences, investment capital, and research. Some of its subsidiaries include, obviously, the biggest one, Google, and then Calico, GV, Capital G, Verily, Waymo, X, Nest Labs, and so on. We'll take a look into some of these subsidiaries later on when we get to the divisions. So first of all, the recommendation, we feel the share is fairly valued at current levels. It's trading at a forward PE of around 22.1 times, as you can see in the graph below. And this is slightly above of its long-term average PE, and it's also above its peer average. Rapid evolution of sector drivers such as cloud and advertising through the emergence of new competition and alternative technologies. It complicates the estimation of a sustainable growth rate, and it also highlights then the need for the consistent innovation. The group holds a strong position in advertising, and market share is maintained by the ongoing product innovations that Google has shown. The secular shift to online spending will remain a big benefit and positive for Google, and the monetization of mobile search is likely to continue to grow towards desktop levels, which is supported by location-based benefits and improving conversion rates. Next, the focus is to position Google Cloud to adapt to changes in regulation, and it will likely support its growth in highly regulated industries, especially the finance and healthcare industry, and continued investment in the group's growth drivers such as cloud and hardware, their mobile search, and as well obviously YouTube is expected to continue to support to their top line growth. Additional value creation is expected through the uptick in areas such as cloud as well as machine learning and tech software. The online advertising space remains highly competitive, which also highlights the need for the continued investment and innovation. Then the last bullet here is changes in the regulation relating to the privacy and data sharing could pose a significant risk for the group. Next, we'll just highlight some main points of their fourth quarter results. Their revenue was up by 24% on a year-on-year basis to $32.3 billion, and this was driven by strong growth revenue across all the regions. The group's largest geographic region is the US, and they generated revenues of $15.4 billion, which is up by 21%. Europe and Middle East Africa revenues was up by 22% to $10.3 billion, while Asia Pacific achieved revenue growth of 30% to $4.7 billion. The revenue from other Americas grew by 31% to $1.9 billion. Now, if you take a look at their total cost of revenues, this includes their traffic acquisition costs. That was up by 34% year on year to $14.3 billion. Traffic acquisition cost stands for TAC, and this is the payments made by internet search companies to their affiliates and online firms to direct consumers and business traffic to their websites. So the main reason why the total cost revenues was up is it was impacted by the Google-driven expenses, such as their data center costs. Now their operating expenses rose by 1.9 billion or to 1.9 billion by 19% on a year-on-year base, and this was driven by an increase in marketing spend over the holiday period. And during the quarter, quick fact is just 2,009 people were added to the staff count, which now totals to 80,110 staff members, and the majority of the new employees were mainly managers or product managers and engineers. Then next, their operating income, that was up by 15.4% to 7.7 billion, while the operating margin was slightly down to 24%. And finally, we get to the adjusted diluted earnings per share. That is up by 25% to 3,486 cents per share, and this is adjusted for the EU fine as well as the $9.9 billion relating to the tax reform. Okay. Now we'll get into the divisions. They split it up into main two categories, namely Google and other bets. Google contributes to 99% of the total group revenue. So basically, the most of Alphabet. And this division delivered 24% revenue growth to $31.9 billion, supported by the robust site revenue growth. Now, this division is then split up into two segments, namely the Google advertising revenues and then also other revenues. The Google advertising achieved revenue growth of 21.5% year on year to $27.2 billion, which was supported by strong growth in the Google Sites revenue. Now, mobile search as well as YouTube were the main drivers behind the 24% increase in Google Sites revenue to $22.2 billion. Then if you look at the other revenues, that was up by 38% to $4.7 billion. Then hardware and cloud, as well as Google Play, were the key drivers behind that 38% growth. Now, the total traffic acquisition cost, still under the Google division, was up by 33% to $6.5 billion, and this accounts for 24% of total advertising revenues, where in 2016 it accounted for 22%. The group's strongest performing areas, like their programmatic and mobile search, carry higher TAC. Then the operating income was up by 11% to $8.8 billion, while the operating margin contracted to 27%. Now taking a look at the other bets division, it's a very interesting division, but only contributes to 1% of the total group revenue. Revenue from the other bets was up to $1.2 billion, and this was supported by growth in Nest, Verily, and Waymo. If you take a look at Nest Labs, like I just mentioned, it is a home automation producer of programmable, self-learning, sensor-driven, also Wi-Fi enabled thermostats, smoke detectors, and security cameras, as well as other security systems. And Nest delivered strong results supported by holiday spend across a range of products, including energy safety, as well as the security products. Nest also increased its footprint to across 12 new countries. And I also mentioned Verily. They are focused on using technology to better understand health, as well as to prevent and detect, as well as manage disease. And they also began a commercial launch of its diabetes management platform with its joint venture with Sanofi. Then the one I also mentioned was Waymo. They announced during the period that Waymo is the only company to have a fleet of completely autonomous cars on public roads. So a very interesting division here, but only contributes 1% to the total group revenue. Now we'll take a look at the company's guidance for 2018. Alphabet will continue to look for opportunities to enhance advertiser as well as user experience as always. And over the medium to long term, the group will concentrate on its strong growth businesses, which is cloud and hardware, as well as YouTube, obviously. Then momentum in the cloud business is supported by the expanding go-to-market team, as well as a fully featured enterprise offering. And over the long term, management expects the other bets division to become the group's third wave of growth. The group expects their traffic acquisition costs to continue to increase as a percentage of site revenue, and that is due to the continued growth in mobile search. The growth of the TAC as a percentage of site revenue is however expected to slow after the first quarter of 2018. Now, lastly, the use of cash will remain focused on the group's primary goal of supporting the organic growth of the business. Then finally, we get to the portfolio guidance. The group offers attractive margins and strong cash generation historically, but we, however, believe that the share is fairly valued at current levels. We would recommend portfolio exposure of 0.97%, but given that it is probably not feasible to allocate such a small percentage to a portfolio, we would recommend a portfolio exposure of 0%. Okay. So just before we end off, please take note of the following disclaimer. And also, please, if you wish to place a trade, please contact the trading desk. Also, if you have any questions, you can type it into the chat box now, and we'll get back to you via email. Thank you so much for joining me today. Please enjoy the rest of your day and also have a great weekend. Thank you so much.